This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, across Bloomberg platforms, I'm Carol Massar here at Bloomberg headquarters in New York City. He is not Tim Stenivek. He is Matthew Miller, who has been all over the place today.
Yeah, a lot going on today. Is this on? This is on. Okay, this is on.
The light means
there's
on.
so much going on today. The amazing gyrations that we had, right?
Yeah.
On Friday, we were down 2.7%.
Right.
Yesterday, we were back up 1.5%. This morning, we were back down 1%. And now we're back up. It's just insane, this trade. And the market clearly just wants to rally.
Well, and I think one of the things is what's happening with U.S.-China trade negotiations. We've definitely seen that's what happened on Friday, right? And we've seen that play out already on Monday and Tuesday here. It's also the big banks reporting. JPMorgan, Goldman, Wells Fargo, Citi. Not all the stocks reacted the same. Investors like some, they didn't like the others.
That's right. JPMorgan and Goldman Sachs both down, even as the market turned higher. So I was talking with Sridhar this morning. We're going to talk to him in a little bit.
Yeah.
And he said, look, the macro picture really does affect these stocks. But I talked to an analyst over at Baird who said the problem with JPMorgan is it's a great company. The stock is too expensive. And that's maybe why it's trading down.
Even though it's down today, it's up 27% year to date. So there you have it, folks. Hey, we're going to talk about that. We're going to get into U.S.-China trade talks ongoing, some starts, some stops. We see that play out. A fascinating story by our Enda Curran. Global trade flows moving on to avoid the highest U.S. tariffs since 1930s. Matt, the world is moving on.
Well, I just wonder if the rare earths risk isn't underappreciated here. I mean, they seem to have us by the short hairs there.
Yeah.
Because
you're talking about China.
Yeah, China, because we, don't even mine them. If we did mine them, we can't refine them. And I'm not sure we could get that off the ground beyond military capability. So they have cards. They have the cards.
Yeah, exactly. All right, lots to come. Also, Matt's big interview with Paul Tudor Jones. There's a lot coming. You don't want to go anywhere for the next 60 minutes. First up, though, let's get a check on the trade. Your top business stories. Here is Charlie Pellet. Welcome back.
Thank you very much. Great to be back. And we're looking at a lot of moving parts to this market, including earnings, including tariffs, and including Fed Chair Jay Powell. A volatile session for the U.S. stock market. As Matt alluded to, Fed Chair Powell reinforcing speculation that officials are on track to cut rates in October amid a weakening labor market. You heard his remarks live on Bloomberg television and radio. The S&P right now up 20. We're close to session highs, up by about 0.3%. The Dow up 425, gain there of 0.9. And we've got NASDAQ lower now by 0.2%. The 10-year at 4.02% now, with a 2-year 3.47%. Gold is up $41 the ounce at $41.51, up 1%. And West Texas Intermediate crude oil down 1.1%. WTI 58.83 a barrel, and Bitcoin down 2.5%, 112,950 now on Bitcoin. Traders are focused on the unofficial start of the earnings season. Among the names reporting this morning, JPMorgan Chase down now by 0.6%, Citigroup surging 4.8%, Wells Fargo up by 8.8%, Goldman down now by 0.3%. Tomorrow we will be hearing from Bank of America and Morgan Stanley. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As Matt and I said, a lot going on this Tuesday. We do want to remind everybody we are monitoring a live event that's happening right now in the White House in the Oval Office. President Trump is meeting with Argentinian President Javier Milei. We're going to continue to follow that. Of course, they've been having a meeting, a luncheon, a bilateral luncheon, if you will, and obviously some significant developments between these two nations.
Well, and look, they're in the cabinet room. In the cabinet room, unless they've added a giant desk to the Oval Office.
Sorry. Okay.
And Scott Bessent talking there because he has pledged to do whatever is necessary to help backstop the Argentinian peso. And it helped for a couple of days, but it isn't helping again. They're just bleeding dollars, and they may not have much left at all. So it'll be interesting. I'm actually going to talk with Hans Humes a little bit later on this afternoon.
He knows this world so well.
Absolutely, and get his take. I'll report back to you.
Distressed, emerging debt, right? All that good stuff.
Especially Argentina.
Man, you are just on fire. All right. We're going to talk about Matt's interview with Paul Tudor Jones a little bit later on, because it was a great listen. I was in the car and I listened to all of it. In the meantime, as we watch and monitor for any headlines out of the meeting in the cabinet room, we do want to talk about that volatile session on Wall Street. Matt and I talked about it at the beginning, right? We've kind of been bouncing around since Friday, if you will. And we did see stocks pairing most of their earlier losses amid hopes of U.S. and China trade negotiations still being on the table. U.S. Trade Rep Jameson Greer telling CNBC that President Trump will is still set to meet his Chinese counterpart, President Xi Jinping. Greer also saying that he thinks we'll be able to work through it with China.
It'll be fine. The president tweeted on Sunday that it'll be fine.
Well, even so, the world is kind of moving on, and we're seeing the new contours of global commerce taking off amid these global tariffs. Let's see what Enda Curran has to say and what it means in terms of the global macro environment. He is Bloomberg News global economy reporter. He joins us from our Bloomberg News Washington, D.C. bureau. Enda, good to have you here. First off, we do see these Wall Street swings on what's coming out between U.S. and China. Why is this still, just remind everybody, why is this still the most important global economic relationship in the world? Or is it starting to kind of change a little bit?
Well, they are the two world's biggest economies. They are, of course, completely interlocked with each other. China is the world's biggest manufacturer, but of course, America is their biggest customer. It's the biggest consumer market in the world. So obviously, the trade tensions between them do spill over to everybody kind of caught in the middle of that in terms of supply chains. And that's what we're kind of seeing some reaction or some response now to the rest of the world, that even if your starting point is that, yes, we'll always have to do business with America because the consumer is so powerful there, trading partners are kicking tires and hang on a sec, who else can I do business with? How else can I diversify my markets? China's looking around, say, buying more agricultural produce from South America, as we know, but also its exports are going gangbusters to parts of the world other than America. And then those other countries in the middle are saying, you know, who else can we start doing more trade deals with? They're accelerating trade negotiations. They're accelerating ways of doing business with each other, looking for new markets. So it's very early stages, but that U.S.-China trade war is starting to poke some change in the global trade.
You know, I mean, I think the question is, the question that J.D. Vance probably doesn't have an answer to, can China be cut off from U.S. trade longer than we can stay solvent? Because the rare earth minerals that they have, we cannot get in size from anywhere else. And we're not going to be able to process them here, to refine them here anytime soon. So, you know, Meredith Whitney, in a note on Sunday, said, aside from the massive dependence on the U.S. industrial complex for these rare earth metals and magnets, the U.S. military is 100% dependent on them and nearly depleted of its reserves. So, I mean, don't we need them more than they need us right now?
Yeah, I think we're all at a point now where we are fully aware that if there is a vulnerability in the hawkish trade stance that the U.S. is taking on China, it's on rare earth supplies. China is the one digging them out of the ground. China is the one that's taking on the refining risk there, the environmental risk, and the costs associated with it at a scale that no other country is doing. And that's why America and everybody else is so reliant on China and getting those minerals out here. And that's why China, of course, it's well aware of its leverage. It's floated those export controls that it did last week or the week before that, of course, have sent shockwaves, not just through the US, but the rest of the world too. And China's making it clear that it's in control of these. Now, this is a policy error, though. If you go back maybe 15 years ago, there was a discussion around rare earth supply at that time. There were other options on the table. It's not just China that has these minerals. Other countries could have put money into the ground and put the money into the resources and the facilities needed to extract these. There are some companies in the US that are talking about or trying to get off the ground at the moment in doing this. But the point is, we're at a stage where China has a grip and a lock on the system to the point where everybody else is years behind. It will take a long time. And
well, it's not just getting them out of the ground. And I mean, I talked to industrial CEOs who do business globally and have told me, look, we've seen the refining process in China, and it is horrific. It is the kind of environmental risk that American voters just would not be willing to take. So no one else can refine them at these levels, at least with today's methods, without sacrificing like a portion of humanity. So we're not going to do that, are we?
Well, And that's entirely right. Environmental risk is a big part of the equation. But there are some companies, by the way, including some in the US, who are looking for cleaner ways to do this. So, but obviously nothing like on the scale that China currently offers. But other countries as well are coming to the table. Pakistan, for example, is floating itself as a potential partner for these minerals for the US. They can be sourced from other countries too. That's why Argentina is in the mix at the moment when we talk about the support that US Treasury is offering Argentina. One of the reasons is because of the minerals that Argentina has. So, but yes, the point is that no one's doing it on the scale that China is right now, and until that changes, China has leverage over the rest of the global trading system.
Hey, I want to go into your story that looks at global trade flows, and you look at what shipping companies are seeing and some of the changes. But there's a quote in the story, an associate professor of economics at the University of California at Davis, Ina Simonoviska, and it says this individual saying it's very clear that we are redrawing the map of international trade. We're going to see a lot more bilateral trade agreements between countries and subgroups of countries. She predicts this. What does that mean for economic growth for individual countries and for the global economy overall? Do we know anything? And is it good? Is it bad?
Well, it's early stages, but we are seeing signs now that countries are looking at accelerating trade negotiations with each other and signing deals with each other. Now, the European Union is one example. They've finally gotten that deal signed with Indonesia. They are getting that big trade negotiation with South America, Mercosur, off the ground, trying to get that ratified. Other countries are also looking at doing business more with each other, like New Zealand and Switzerland and the UAE are among a group who've gotten together in this kind of a loose trading agreement that they've pulled together over recent months. And the point of all of this is as I said at the start, it's nobody suggesting the US is not the world's biggest consumer market and that they don't want to do business here. That's not the point. But they're seeing the tariffs going up at the fastest pace since World War II. It's more complicated, more costly for some of the businesses who want to do trade with the US, and they're asking what else can they do to diversify and mix up their supply lines and their markets. And we're seeing it in Peruvian fruit farmers. They're looking for new and alternative markets. In Lesotho, they're looking for alternative textile markets, maybe in Europe and in Asia. So, you know, as I say, the tariff wall, when it's gone up on the US side, it's not about countries not wanting to do business here, but they are certainly kicking tires on where else they can diversify. And that's what these trade negotiations are getting a shot in the arm, as one of the professors quoting the article said to us.
All right, we're talking with Enda Curran, global economy reporter at Bloomberg News in our D.C. bureau. At the same time, we are monitoring the White House, the cabinet room. President Trump is there with President Milei of Argentina. They are having a bilateral lunch and obviously a meeting. We're monitoring any headlines that come out of that meeting. In the meantime, you know, and you talk about in this story these bilateral relationships, or at least folks that you talk to are talking about a lot more bilateral trade agreements. Who wins, though? Big countries, small countries, middle-sized countries? Is there clear winners and losers on that metric?
Well, probably the biggest countries will be the ones who come out of this in better order, because, you know, the system up until now, whether one agrees with it or not, but the broad system up until a few years ago had been rules of the road set by the World Trade Organization. This is where countries big and small could come together and have their disagreement and argue out their case for whatever their grievance was in the trade world. But, you know, we've moved past that now. We're kind of moving to this bilateral sort of approach to doing trade deals. So when you have a big country, they're able to set the terms on the table, and the smaller country, of course, has to work around that. And that's where we are. It's not just the US, of course. China is the other big player in the global trading system. They, as we just spoke about, hold the cards in so many areas now when it comes to not just rare earths, but they're the world's, you know, factory. So they also will set terms, and countries are worried about China's volume of exports and trying to compete against China too, given the scale and competitiveness at which they can produce products versus other countries. So the big picture is better for bigger countries, tougher for smaller countries. All
right, Enda Curran, thank you so much on today's news and his story. Global economy reporter at Bloomberg News. You can read the entirety of it. It's on the Bloomberg and at Bloomberg.com. Enda talking about important relationships, U.S. and China, certainly. But right now, what is top of mind for President Trump at the White House in the cabinet room is a relationship with Argentina, and he's there with President Milei. Let's listen in. All right, you are listening to President Trump. He is live there at the White House in the cabinet room there, of course. with Argentinian President Milei. An array of topics coming up, but in terms of the relationship between the two countries, the president being asked if there was a free trade agreement possibly with Argentina. He says it's possible. He also, Matt, was asked about the U.S. swap that is underway between the two nations involving currencies, the two currencies of the two nations, not predicated on Argentina ending the China swap, which has been there to help up Argentinian reserves. So a little bit more on that relationship. Sounds like still some questions to come.
Yeah, he's talking about his relationship with President Xi. And I'll just point out that is what shifts these markets. So when he makes a statement that's very negative and aggressive about President Xi or China, then you get a sell-off the likes of which we saw on Friday, 2.7%, 182 points off the S&P. When he makes a statement that's more positive, like he did on Sunday, China's going to be fine. He just said again, I think the relationship with China will be fine. Then you have a market rally. Then you have investors coming in to buy the dip. Today we saw it turn around, as you know, because Jaime and Greer on CNBC said that the two are still going to meet. So if he says anything about President Xi right now, that could turn the market. I'll continue to monitor the headlines.
All right, sounds good. And we do have most names in the S&P 500, over 400 higher today, folks. Here's where the S&P is. It's up 18 points. So at its highs of this session, the Dow Jones Industrial Average, a gain of 392 points, up 0.8%. NASDAQ 100 still under a little bit of pressure, but it's had quite a run over the last few months, down just about 20 points. So call it pretty much unchanged on the day. One group that has done really well today as a whole, we're talking about big banks or banks overall. The KBW Bank Index, folks, up 2.3%. 22 of the 24 names are higher in today's session. We've had
two big ones lower. Two of the big ones are lower. Two of the biggest names on the entire index are lower.
Well, this is what's interesting, because JPMorgan, Goldman, Wells, Citi all reporting. JPMorgan and Goldman selling off, right? And those are the two names you're talking about. And Wells and Citi, Matt, are rallying in a big way.
I mean, and you get headlines like JPMorgan beats expectations on every level. Goldman Sachs knocks the cover off the ball. Analysts can't believe how well they did. And yet the stocks sell off.
But remember, something like JPMorgan has had quite a run this year. So, you know, expectations and reality, perhaps. Let's see what our experts have to say. Bloomberg News Chief Wall Street Correspondent Sridhar Natarajan's here in studio, along with Bloomberg Intelligence Senior Analyst for Global Investment Banks and Asset Managers, Alison Williams, as I said, both in studio. All right, guys, let's start with JPMorgan, because I feel like that's the bank that we want to always hear from. Alison, let me start with you. What do we need to know about the numbers in JPMorgan's business? Because as Matt says, sometimes the headlines look darn good.
And the quarter was darn good. It's just that I think there are some bullish investors out there that wanted more. And if you did, you know, so on today, they're underperforming. But if you looked at year to date, if you look at their valuation, if you look at their year to returns, you look at their profitability, all very, very good, executing well. Think that, you know, maybe some people just wanted some more there. Goldman Sachs, also strong quarter. They did miss on equities trading. So, you know, these numbers are hard to predict. But I think, you know, most people, including myself, you know, if you had seen sort of that upside, would give you sort of further confidence in the momentum going into the next quarter. But the M&A advisory business, huge outperformance there. We think they probably outperformed most people in the quarter. They're the lead in that revenue. They announced this AI program. There's details. You know, we're going to have to wait till January for details, but that signals that efficiency is going to get better. You know, contrast, you know, two companies that are really performing very well to two companies that are, I think, have a lot of runway ahead of them, and that's Wells Fargo and Citigroup.
Can I just ask, before we get to Sri, because I've already asked him like 10 times today, why do the analysts consistently underestimate what these banks are doing? And it can't just be to get on the good side of management, right? When I see this morning, before any earnings came out, I saw stories about which bank was going to beat estimates. So when I see bank expected to top estimates, I wonder why analysts don't add more to the estimates. What is this game all about?
Well, first of all, trading, and when it's capital markets revenue, that really is the source of the upside. That is very tough. And banks are not going to guide you.
Right.
You know, they don't really have an incentive to guide you. Because by the way, like the last couple of days of the quarter could be horrible, or you don't know what's going to happen. And so I think banks are going to tend to guide conservatively. Analysts are going to tend to be conservative, right? Because that And by the way, like that just is not something that people bake into the run rate. So as I said, we're positive about the momentum in trading, the asset levels, et cetera. But I think if you're, forming estimates, you are going to tend to be conservative. And that's why you can get upside, especially if the strength comes at the end of the quarter. It's just hard for the estimates to catch up.
Yeah, totally get it. All right, so we care about JPMorgan's results. We also obsess over everything that Jamie Dimon has to say. He never disappoints with something that is highly quotable. In this case, it was when he was talking about a cockroach. Check it out.
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay and other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
All right, that, of course, was Jamie Dimon earlier today on JPM's earnings call. Sri, come on in on this because you're reporting on the quarter and, most importantly, what Jamie Dimon has to say about the macro.
So Jamie Dimon has been running the biggest U.S. bank, which has a bigger market cap today than its three closest rivals combined. He's been doing that for nearly 20 years, and he didn't get there and he didn't stay there just on the back of sitting on his laurels, right? He is paid to look around the corners, and he is right to point out that the underlying numbers might be great. They might be marching toward another record revenue year. But when you see some of these problems, you initially try and dismiss some of them as idiosyncratic. But if enough of them start popping up, that becomes a concern. So that's why when Dimon says my antenna goes up when things like that happen, we pay attention, especially because in the last few days, we've been seeing some action in certain corners of the credit market where it does appear that there is some fear seeping into the markets. Dimon specifically flicked at the publicly traded BDCs that hold a lot of these private credit investments. And if you look at the discount to the net asset value that they're going at, it makes you worry about what's happening with some of the other non-traded vehicles. Will there be mass redemptions and will there be domino effects off of that? And Dimon also points out that he feels like they're feeling very good about everything. There, if you look at their numbers, you will not see any cause for stress, dismay, concern. But Dimon is right in saying eventually the cycle turns. And when it does, he thinks that, I suspect, when there's a downturn, his words, you will see higher than normal downturn type of credit losses in certain categories. And that's an important one to keep in mind, because what he's saying is your recovery rates might not be as great as you imagined, and that will impact the firms and that'll impact the investors in those firms.
I want to ask about Wells Fargo. I'm so thankful that Bloomberg Radio has such a great program in the mornings. Nathan Hager and Curran Moscow were talking to you, Alison, before I even got to work yet, and I get here pretty early. And you were saying this is really going to be the news of the day. And it has been the outperformer of the day because...
Can I just say, finally?
Well, because...
It's been long in coming.
So what's the story with Wells Fargo? They raised their return on tangible equity.
Yep. So the key metric for banks, return on tangible common equity, valuations, price to book is how a lot of investors value these banks. It's based on the return on capital. And, Charlie Scharf had said years ago, we're going to put 15% out there as a target. We'll revisit it at some point. They're running at 15% year to date. They upped that target to 17 to 18%. The asset cap is lifted. They showed a lot of progress that they've made, but they also showed some opportunity. And here's what I think is interesting. So one of the biggest areas of opportunity is the consumer unit. When we had Lori Beer from JPMorgan, the CIO of JPMorgan, talk about where she sees big opportunity. She actually talked about this at JPMorgan's Investor Day. Also, the consumer unit. Also, like a lot of what she talked about in terms of how technology was going to aid the bank was productivity in the consumer unit. So we're hearing that from Wells Fargo. So that really gives me confidence that this is a number that they can shoot to. Citigroup, by the way, I think they're also kind of showing the path, right? So Citigroup talking about the fact that they are sort of 2/3 the way there with their transformation. And we have Banamex coming. It's pushed out a little bit, but I think showing you the path that could that be Citigroup again? Talk about an even longer time, but could Jane Fraser finally be the one to get it done?
And I will point out, like with Wells Fargo now up 8.2% for the day, it's their best day since election night, since Trump came back to power. This could be Wells Fargo's best day since then. So that is the power of putting a target out there. And I point that out again only because in a couple of weeks, you will have Bank of America with their investor day, their first investor day in 15 years. It has also been the worst performing big bank stock this year, up only, 14%, 14 and change. It is important for Bank of America to approach that investor day with a mindset of providing targets, aspirational targets for the market, instead of wanting to go out there with trying to explain to investors and analysts what it is that they do. Because I think investors will tell you they have a good understanding. What they want is better targets, and what they want is them achieving those targets. Otherwise, the stock will continue to languish.
All right. I do want to mention a headline crossing. We are continuing to monitor President Trump there at the White House. He is talking also about Russia and President Putin, saying President Putin does not want to end the war, and then going on to say that the Russian economy is going to collapse. So that is certainly another one of the big geopolitical events and actions that we've been keeping, and something that the president has been trying to bring an end to, and talked about that on the campaign trail. But again, President Putin doesn't want to end the war. That is the view from President Trump at the White House. I know you had one last question you wanted to.
Yeah, I wanted to ask Alison about the best way to value these companies. I was talking with Sri about this on Bloomberg TV earlier, and David George from Baird also was saying, like, look, JPMorgan can be a fantastic company, and it is. But the stock is just too expensive, which is why he doesn't have a buy rating on those shares. And then Sri and I were looking through the price to book. What is the best way? How do the best bank investors look at valuations that makes the most sense for banks? Because I think it's a little different than other equities.
It is different because, so if you think about banks, right, versus other kind of companies, they use their balance sheet to generate profits. And so that's why return on tangible common equity is a key metric, right? Because the more profitability that you can generate using your balance sheet, the more you're willing to pay. So that's a little bit different than PE. You will notice that price to book is really favored in downturns. It's a place where people look for, in terms of, 1 times price to book is sort of if you liquidate the bank, what can I get for this, versus the ongoing returns. And that's why you have companies like Citigroup trading below tangible book or below book, which obviously they've made a lot of progress since then, but for a long time,
I remember Deutsche Bank was trading at like 20% book value.
Right. Well, and the European banks, right? Because they're not earning their cost of capital. So basically you're eroding value over the time. So that's sort of the opposite. And so I think, those are kind of like two different ways to think about it. By the way, JPMorgan management also talking about they're not liking to buy shares back at this level.
I heard that.
They're pretty daring that they're willing to call that out. But from an equity investor standpoint, that's not really helpful either.
Hey, 20 seconds, Sri. What do we have? B of A and Morgan Stanley tomorrow. Just quickly, what you're watching out for?
We have B of A, Morgan Stanley tomorrow. Again, we have analyst expectations set out there, so we're hoping they'll go and beat them. But which brings us back full circle to Matt's original point. Like, I don't know what he wants analysts to do. Should they apply a humility premium to when exectives guide you in a certain direction?
If I were estimating someone's earnings, I would try and get it right. And if I was lowballing it for the last 9 out of 10 quarters, I would just add 20% or something.
You're doing it based off how the executives are guiding you. What do you want? A gut check premium?
All right. Hey, kids, take this outside, okay? All right, we're going to continue this conversation. We will here at Bloomberg as we continue the bank earnings throughout the rest of this week. Right now, let's get a check on the trading session. Here is Charlie Pellet.
Very much. Bank of America, which does report tomorrow, up 2.8%. Morgan Stanley, also tomorrow, up now by just about 0.7%. U.S. stocks, we're trading mixed. We have got the Dow, the S&P, they're both higher. NASDAQ in the red. S&P up 16, up by about 0.2%. The Dow now up 0.8% after earlier losses. NASDAQ, though, in the red. NASDAQ Composite Index down 48, drop there of 0.2%. Your 10-year, 4.02% for the 2-year, 3.47%. Spot gold up 1%, 41.49 the ounce. West Texas Intermediate crude oil down 1.1%, 58.83 a barrel on WTI. and Bitcoin now at 113,085, trading lower by 2.4%. So again, recapping here, S&P 500 index holding on to a gain of 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, Wall Street has spent years preparing for $105 trillion to pass from elderly parents to their kids, but a different kind of wealth transfer is already underway. We talked about this a little bit yesterday, Matt. More than a dozen women in the world's 500 richest people have become billionaires after the death of a spouse. So watch it, guys. No, I'm just kidding. It's the highest number ever.
But it makes sense because men naturally die at an earlier age than women.
I didn't mean anything sketchy there.
If you marry a woman who is your age, which I guess is not so normal among the ultra wealthy, you're likely to die before her.
Yeah, it's just logical. And people have reported on this, so it's nothing crazy like, a bad murder series or something.
Did you see what Stephen Colbert said?
What did he say?
He said if his wife dies, he's going like within a month because he can't imagine life without her. I think that's probably also something that happens quite often.
My husband would do the same thing.
Yeah.
But let's talk about it because there is this incredible wealth transfer and also wealth concentration when it comes to women. So let's get into it. In this week's Women, Money, and Power, we're exploring how this shift is creating huge implications for how vast sums of money are invested, philanthropy, and the way that wealth is passed on to the next generation. Back with us is Jaime Magyera. She is head of U.S. Wealth Advisory and head of retirement at BlackRock. It's the world's largest asset manager. They notched a record $13.5 trillion in assets. It's up from $1 million when we last talked in June. And we got the figure when BlackRock reported. I don't know that I said your name correctly.
Magyera.
Okay.
It was great.
It's been
just
a crazy Tuesday.
Just like it's
Magyera.
Just like it.
Well, I really like Jaime, so I want to get it right. Great to talk with you. How are you?
Great. It's really good to be back with you.
Well, we are talking about the environment generally. So let's start there. I know we did that over the summer when we talked because BlackRock just sees so much in terms of the funds it oversees and the flows. And the flows continue to grow, but that doesn't mean the flows are always going in the same places. What can you give us insight in terms of where money is going and where money is going out of?
Yeah. So first of all, excellent to be here. And you started by talking about flows. I'm going to take a gender perspective on flows.
Yeah.
And talk to you a little bit about where we see money going globally with women. And so women more and more are earning wealth, they're acquiring wealth, they're owning wealth, they're playing a larger role in capital markets. They are investing and benefiting from these capital markets, and we think there's no better sign of hope in the future than having people invest and grow along the capital markets.
Is it because they're earning in it themselves and they're having some say, or is it also in terms of couples because they are often breadwinners as well, that they also have a say at the table?
Yeah, so it's both, right? So when you think about women, women are more often now becoming breadwinners, primary breadwinners quite often. They're also contributing to household along with their spouses. They're earning more money, but they're also acquiring, and you mentioned the wealth transfer.
Yeah.
We think about that in two ways. There's the intergenerational wealth transfer where they're gaining assets maybe from their parents as they pass away. But the more interesting one is this horizontal transfer, right? So if a spouse passes away or if there's a divorce, women are acquiring assets in that way. And they need financial advisors to help. They're reshaping the industry. And women have just not been served in the way they need to be served in the past.
We think about that, right, with Melinda Gates.
Yeah.
We think about it with, Jeff Bezos.
No one died in the Gates
No, but I'm just saying there was big divorces.
Oh, I got
and
you.
all
Yeah,
of a sudden you had significant players, certainly in wealth overall, but also in philanthropy.
Yes.
Actually, Cerulli estimates that globally, $124 trillion will change hands in this silver tsunami, and then their current forecasts are that 54 trillion will be passed to spouses first before it goes down another generation. So 40% of those spousal transfers will be to women. So this is what Sally Krawcheck calls the feminization of wealth. And the idea is that the important idea, I think, here for your industry, is that when women get hold of this money, they often don't stick with their same wealth managers. They often say, you know what, I'm going to go with someone else now. So what do you do if you want to get hold of a piece of that pie?
Yeah, so maybe I might even just dimensionalize what you mentioned, because I think about it in percentages. So today, let's call it women responsible and controlling 30% of the world's wealth. That will be 50% by 2030. That will be 70% by 2070. So these are big numbers.
Pretty amazing.
Big numbers.
Yeah.
And women, as you say, they do things differently, right? And they want to do things differently. And oftentimes when they're getting a hold of this wealth, right, when wealth is passing to them either through their parents and family or through their spouses, they want to do it differently. They want to be served differently. 70% of women leave their husband's financial advisor after a divorce or a death within 1 year.
Wow.
70%.
Why is that?
Because they oftentimes felt not heard, not part of the conversation, not at the table and making decisions. You know, there's a lot of misconceptions around women, right? People think women aren't engaged with finances. Just not true. A third of U.S. households have women as the primary financial decision maker. People think women or call women perhaps a bit risk averse.
Well, that's what I wanted to ask you. Are women risk averse? Like, give me an idea when you're talking about investments. I mean, we've been thinking about the AI trade or private assets. Are they risk averse?
So we did a study.
I hate to make generalizations,
no,
but I'm curious if there are any.
True. Yeah, so not a monolith, right? Women are very different. All my friends are different than me. We all do different things and need different things. But generally speaking, we did a study with 2,500 female investors. When we talked to them about their risk tolerance, the majority of them were actually moderate to aggressive because they saw the power of not just gaining wealth through working or through transition, but actually gaining wealth through the capital markets, right? Investing in items that will, and securities and portfolios that will actually help them grow their portfolio. Private markets is a great example. Again, for a financial advisor to play that role and help and coach and guide a woman in how she thinks about her portfolio across public and private. Last time we were together, we talked about direct indexing and the role of taxes or, you know, women oftentimes want to. You're laughing.
Gets me excited, direct indexing.
Yeah,
I love it. You know what? I anchored the ETF show for a long time, and that's a big part of that discussion as well. You know what? It's not just women. Obviously, kids are going to get hold of a lot of this money, and I think I'm not sure about women, but I know with younger people, they want to do more impact investing than their parents did or their grandparents did. So is that also a key to try? Because I'm thinking from the perspective of a wealth manager who wants more business. Right. So what I need to do is say, hey, I can set up some direct indexing for you, and I can help you make an impact with the money you invest. It's not just to make more money. You're also going to change some part of the world that you want to. Is that the case?
It is. And I like to use the word purpose because actually impact has many different meanings. And so if I'm a financial advisor and I'm working with a younger client or a woman, I'm going to be talking to them, by the way, men too, right? It's not just about the impact you're having. You could invest in a way that maybe aligns with your values, right? Maybe you have certain values that are important to you to hold in that portfolio.
I love motorcycles, so I would want to buy
holding. There we go.
Ducati stock.
There we go.
But you know, I often wonder about that because, you know, if you care about the environment, but if an investment doesn't pay, are people doing that because they believe in it, but it may not return as much as something else?
I'm going to give you an answer that will be terribly unfulfilling. It depends. Okay. Right? So there are people, and by the way, let's step away from the portfolio for a moment and say, what about philanthropy? This is where I come back to purpose, right? People are looking to put their money to good cause. And that might be philanthropic, it might be impact in their portfolio, it might be aligning with the values I have. It might also be sending my children to school or helping my elderly parents. Right. Or starting a new business, right? How about that for purpose?
Or shielding your money from taxes, right? I mean, I guess I'd be willing to take somewhat of a loss by putting my money into a philanthropic vehicle, especially if it's compared to a much bigger loss by giving it away to Uncle Sam and state and local and federal taxes.
Absolutely. And again, that's where
you don't look at things in a vacuum. You have to look at them overall.
Holistic wealth planning, and again, the role of a financial advisor is critical there.
Got to ask you, just in general, when you look at this environment, and we talk a lot about a bubble right now. I don't know. What is your take on it? What are the conversations you're having with clients about how they feel about it? Are they a little nervous about that trade?
Yeah, we talk to clients, advisors, end clients, institutions globally all the time. Look, the markets are the markets, and there are long-term investors that need to just keep staying with the markets. We talk about it's not time in the market or timing the markets, it's time in the markets. The other thing, though, is you just have to acknowledge that there's uncertainty out there. right? There is volatility. There are things going on in the markets that, again, everyday people, let's take it to America and Americans, everyday people need professional advice. They need someone they can trust that will help them navigate that through professionally managed solutions or through advice. But there is uncertainty out there. But again, we come back to it's time in the market, not timing the market.
20 seconds, Jaime. I mean, are more people feeling comfortable putting money to work? Or are they, after kind of a nice bounce from the April lows, or they're like, I'm good, I'm done, I want to be a little bit more conservative? Just quickly.
No, we are seeing flows into portfolios in ways that are across.
As I said, BlackRock was up $1 trillion since the summer we talked.
We are having the best conversations we have ever been having with financial advisors, institutions, and wealth managers across the world. People are very interested. Okay, yeah. Good. Jaime, thank you so much. Glad we got some time. Jaime Magyera, she's head of U.S. Wealth Advisory, head of retirement over at BlackRock, joining us here in studio. Matthew, where are you going?
I have to go to TV.
Oh, okay. Boy, this is a crazy world. He was on TV, but he's going to go again to TV. If you are watching on TV, the close is coming your way. Bloomberg Businessweek Daily continues.